Hello and welcome to Insurance in Canada. I'm your host, Rick Pineda. Thank you so much for joining me. I've been away for the last couple of weeks, which is why I haven't uploaded, but I'm back and ready to look at three news stories from the world of insurance. The first one from British Columbia, from ICBC regarding rates for Autoplan, their automobile insurance product for next year. Second story comes out of the 2025 federal budget regarding steps taken to help with potential earthquake issues. And last story also comes from BC, a story about a individual who sold a vehicle yet was still liable for the uh, charges that the vehicle accrued even after he sold it. So without further ado, let's take a look at insurance in the news. So our first story today comes from British Columbia, an announcement the week before last from ICBC regarding where rates will be going for next year for their automobile insurance product. For those of you who are not familiar with the way auto insurance works in British Columbia, all mandatory coverages, mostly the minimum liability of $200,000, accident benefits, that has to be purchased through the Crown Corporation, the Insurance Corporation of British Columbia. Optional coverages like higher liability limits, loss or damage coverage, collision comprehensive, that can either be purchased through ICBC or a private insurance company. So that's how it works in the provinces that have government-run insurance for the mandatory coverages like British Columbia, Saskatchewan, and Manitoba. So it's not 100% government-run. Private insurance companies do operate in those provinces as well. So let's see what ICBC has to say for next year's rates. So no basic auto insurance rate increase until spring 2027. The Insurance Corporation of British Columbia will not increase the rates for basic auto insurance this year. ICBC says the Crown Corporation's finances do not require a change through to the 2026-27 fiscal year, keeping basic insurance rates low and stable as part of the government's commitment to affordability and help manage their day-to-day budgets, says Nikki Sharma, Attorney General for Minister responsible for ICBC. This marks the 7th consecutive year that the Crown Corporation has not increased the rates. So I can tell you folks in British Columbia that is not what we're experiencing in those provinces that have private insurance plans, 100% private insurance schemes like we do have here in Ontario, Alberta, pretty much every province except Saskatchewan, Manitoba, and British Columbia. Quebec kind of has their own unique thing, but outside of those provinces, the other provinces have private insurance, and I can tell you for the last 7 years, there have not been no rate increases in those ones. Some of those provinces have seen double-digit rate increases per year, never mind cumulative for the last 7 years. So I know people in British Columbia. I used to live in British Columbia for a while, and they like to complain about ICBC, but careful what you wish for, because you can complain about them all that you want, but the private insurance companies haven't figured out how to keep rates stable either. So back to the article. With insurance rates stable, we can put our efforts towards enhancing customer experience and expanding online services, said ICBC Interim CEO and President Jason McDaniel. The Crown Corporation did not say if the rates will be increased in the 2027-28 fiscal year. Any potential rate increase would have to be submitted to the BC Utilities Commission the year before. We're making sure drivers have access to affordable coverage and some of the strongest care and recovery benefits in the country without compromising financial sustainability, Sharman added. So that's the news out of British Columbia regarding auto insurance rates. Some good news. Hopefully, it's the way people in British Columbia are going to interpret as being good news, anyways. That's now obviously that's insurance. Their rates. Individuals may see their individual premiums stay the same, could go down, could increase based on their individual rating factors. So these are overall rates, but obviously individuals' premiums may vary depending on their circumstances. Looking now to what's in the 2025 federal budget regarding ability to deal with potential earthquakes, damages from earthquake scenarios, and the IBC's lobbying of the federal government to address this in the federal budget. So 2025 federal budget promises to move the needle on quake backstop. Insurance experts say they welcome the federal government's pledge to consult on an earthquake backstop. After decades of Canadian property and casualty insurers lobbying for a federal government backstop for earthquake losses, the Liberal government's 2025 budget signals its intent to start that conversation formally. More can be done to ensure Canadian consumers are protected by a resilient financial system in face of extreme events like earthquakes, 2025 budget says. In its sole reference to the topic, Budget 2025 announces the government's intention to consult federally regulated property and casualty insurers and other interested stakeholders on ways to ensure the stability of Canada's insurance sectors in an extreme earthquake event. Despite the brevity of that statement in the budget, it's music to the ears of the industry. A major earthquake isn't hypothetical. Insurance Brokers Association of Canada CEO Peter Braid said of the announcement, "We have been raising the alarm on earthquake risk and the potentially devastating impacts not only on people in the affected region, but on all Canadians. We look forward to participating in these discussions and providing this perspective of insurance brokers who have on-the-ground experience and understand the challenges of the earthquake insurance product in their respective communities." In response to the budget, Insurance Bureau of Canada said it has been calling for years for the federal government to help protect Canadians from the economic fallout in the event of a major earthquake. Canada is the only G7 country with a significant earthquake risk that lacks a formal government-backed financial backstop for earthquakes, said Leah McGinty, Insurance Bureau of Canada's Vice President for Federal Affairs. Without a federal backstop, a major quake could trigger widespread financial instability. Modeling shows that a major earthquake off the coast of BC would have a staggering impact on Canada, nearly $100 billion in total economic losses. In Quebec, a smaller earthquake could produce losses in the tens of billions of dollars. In either scenario, the economic and social repercussions could extend across the country, posing a foundational threat to Canada's economy. It's understandable where they're coming from. I know in the figures they're presenting, it's a bit of a doom and gloom scenario, like the worst case scenario. Now, earthquake threat in Canada seems to be localized mainly to the west coast and certain the Laurentian Valley, mostly in Quebec. You don't see too much cause for concern for earthquakes when it comes to central Canada, most of western Canada, even on the east coast. It's not to say that it can't happen, but it's not as big a concern when it comes to the rest of Canada as opposed to the areas that it affects. So the talk about the impacts for the rest of for Canada as a whole when we're talking about earthquakes, it may be a harder sell for those provinces that aren't as concerned as, say, those provinces that are. Back to the article, IBC is eager to partner with the government to quickly find a solution that will protect Canadians in the aftermath of a catastrophic earthquake. In the Ottawa, Montreal, Quebec City corridor, which sits on a seismic zone, the quake insurance take-up rate is about 3%. Industry sources have previously told Canadian underwriters. So take-up rate is a percentage of policyholders who actually purchase the coverage. So it's saying that 3% of policyholders in that particular area purchase the earthquake coverage. I don't know if it's talking about commercial lines, personal lines, or both commercial and personal lines. And in BC, at the Insurance Brokers Association of BC's Leadership Conference last June, Institute for Catastrophic Loss Reduction Executive Director Paul Kovacs indicated about 61% of residents in the lower Vancouver mainland have purchased earthquake coverage, while 39% have not. And yet, if a major earthquake of magnitude 7.5 hit the City Hall area of Vancouver, only 8% of earthquake policyholders in BC would experience damage high enough to trigger a significant claims payment under their home insurance policy, he added. So there could be a reason why the uptake, especially in the Quebec City, Montreal, Laurentian Valley areas, as low as it is. Obviously, it's going to be higher in British Columbia. I used to be a broker out in BC, and I can tell you out in BC, if you want, at least back when I was a broker, if you want to purchase a house and take a mortgage, the financial institution, bank, whatever, whoever it is that's going to be lending you the money to purchase that money, is going to require that you have earthquake coverage under your homeowner's policy. I am guessing that banks in Quebec do not have that same requirement. So that's one reason why the uptake in BC is as high as 61%. Uh, Mostly because that requirement that if you have a mortgage, the mortgage company is going to require that you have earthquake coverage under your homeowner's policy, your commercial policy, if you're purchasing a commercial property. But like I said, other provinces don't seem to have that same requirement. The second reason why the uptake can be as low as it is the last time that those particular areas had a major earthquake. I did a bit of research in Quebec. The last time that they experienced a major earthquake was in the La Pocatière region of Quebec. It was a magnitude 6.3. I know they didn't use a Richter scale anymore. They use a different scale, but hopefully we understand a 6.3 as a relative scale anyways. That was 100 years ago that they had that magnitude 6.3. In British Columbia, the largest one they've had recently was back in 2012, and that was a magnitude 7.7, and that was offshore. That was in the ocean bed that occurred. The last onshore earthquake, major one, was a magnitude 7.3 that occurred on Vancouver Island, and that was in June 1946. So in both cases, many generations have gone by and not have experienced this large earthquake that would probably be what's needed in order to wake people up to the actual seriousness of, yes, you are in an earthquake area, and yes, it can potentially destroy your home, your business, whatnot. So obviously it seems to be a bit more of a concern when it comes to British Columbia than it does in the Quebec area, which is probably why the banks don't require it as a mandatory coverage under your homeowner's policy in order to have the mortgage. But that could be another reason that the 39% of people in BC decide not to purchase it, is just because they haven't seen this earthquake, this major earthquake we keep talking about, in their lifetimes, or possibly even in their parents' lifetimes. So it's kind of an out of sight, out of mind situation for people in BC, and probably even more so in people in Quebec, considering how long ago that 6.3 was. You look at other major earthquakes that have happened at least in my lifetime. I think about the one that occurred in San Francisco back in the late 80s. That was a pretty devastating earthquake, but that was, almost 40 years ago, probably by this time. So once again, generations have gone by and haven't seen that kind of earthquake occur. So once again, it's the out of sight, out of mind mentality that might be taking hold of policyholders, younger policyholders, just because they haven't seen it. Once again, it's one of those things that we keep talking about, that it's going to happen, going to happen, going to happen, but we don't see it happen. It's always that thing that's sort of Damocles that's hanging over everybody's head in those areas, that's just waiting for it to fall. But like I said, generations keep going by and that sword hasn't fallen yet. You start to, because earthquake coverage is not a cheap coverage, especially in those areas that need that coverage. It can add several $100s to your premium on top of what you're already paying. And insurance in places like British Columbia, homeowners insurance is already pretty expensive, just because of the number of water damage claims and fire claims because of the wildfires that they experience in those areas. And asking the homeowners to take on another coverage that's going to add 30-40% already to their premiums. Yeah, it's understandable why 39% have decided to go without that coverage. So that's just my opinion as to reasons why the uptake is as low as it is. But let me know what you think. Let me know if what I say makes sense or if I'm totally off base. Or if you're in BC or in the Laurentian Valley of Quebec and you don't have that coverage, let us know why. Let us know your experience. Let us know your opinion. And another issue is the deductible, which is what the next paragraph in the article touches on. Policy deductibles for a BC quake can be as high as 10 to 20%, with the average price of a Vancouver detached home being just over $2 million, according to the January 2025 study by Vancity Bank. That would put the quake deductible for the average homeowner anywhere between $200,000 and $400,000. The deductible is not based on the retail or the market value of the house. It's on the replacement value. So you could have a detached home worth $2 million in Vancouver. Does not necessarily mean it's going to cost $2 million to rebuild that house if it was completely destroyed. So we'll just take with the average price of a Vancouver detached home and instead go with the average replacement cost of a Vancouver detached home being over $2 million. I don't think it's that high, but let's just assume that the average replacement value, average replacement cost of a home being $2 million. Yeah, that's the other issue, is the deductible. Here in Ontario, you can purchase earthquake coverage for your homeowners, for your personal property policy. You find earthquake coverage pretty common on commercial policies. Not so much on homeowners policies. Even my homeowners policy, and I live here in the GTA, Greater Toronto area of Ontario. I don't have home earthquake coverage on my policies. It's just not it's a possibility, but quite frankly, I have to look more at probabilities and possibilities when I'm trying to decide the coverages, not only for my own policy, but my customers' policies as well. But what it's saying here, in Ontario, the deductible would not be as 10 to 20%. Most insurance companies, 3 to 5% is the deductible, but that's because we're in a very low risk area for earthquakes. But if you have that deductible 10 to 20% and your deductible is 200,000 to 400,000, yeah, you're going to need a very substantial earthquake in order for any sort of claim to be covered under your homeowner's policy. So that could be another reason why, just because who has that kind of money sitting around to pay for as a deductible under your homeowner's policy? Even if you slash that 2 million to 1 million, now it's 100,000 to 200,000 deductible. Once again, who has that kind of money just lying around, except for the extremely wealthy, to cover that kind of deductibles? So that's another reason why you pay several $100s a year for that coverage, and you're probably never going to be able to cover the deductible yourself if something were to happen. Back to the article, but a magnitude 7.5 quake isn't the highest in the range of double quake scenarios. Alistair Campbell, president and CEO of Property Casualty Insurance Compensation Corporation, told brokers attending the IBABC conference on June 11th. We asked the people of Natural Resources Canada to give us a quake scenario, and they gave us a scenario that scared the wits out of us, and they assured us it was not the one that kept them up at night. It was easily in the range for them. Campbell outlined NRC's, or National Resources Canada, full scenario as follows. The big 9.0 Cascadia quake happens. It's the worst thing that's happened to Canada since the colonizers arrived. Really, buddy? That's the colonizers arrived? That's the language you're going to use? Oh, boy. Okay. And all of a sudden, his opinion seems to no longer matter. That volume of loss could impact insurers' ability to stay profitable in a matter of months. The mega quake would cause three small regional insurers, each with a high concentration of quake risks in their book of business, to go under, according to PACICC's systemic quake risk model of the NRC scenario. So in conclusion, it doesn't seem like much is going to be done besides consultations. That seems to be the only thing the budgets is talking about, is just consulting with property and casualty insurers and probably the regulators as well. But quite frankly, in my opinion anyways, if you want action to be taken, well, right now it says 69% of policy, or 61% of policyholders in the BC, or at least the lower Vancouver mainland, it could be higher or lower for all of British Columbia, have purchased the coverage. Well, make the insurers take that premium they're collecting for earthquake and put it away. Stick it in a savings account. Not a savings account, but some sort of investment. Don't just let it go into general revenues. Build up this fund that's going to be used to pay these exorbitant claims to protect the insurance companies from going under. I mean, if they've been, creating this fund for potential catastrophic earthquake losses, for the last 20 years, how many billions of dollars would be in that fund right now? Never mind any additional interest or anything. You can let the insurance companies, any interest they're making off of this fund go into their general revenues. That's fine. But like I said, if they're that concerned, then take those premiums you've been collecting and put it into some sort of fund, and let's get that fund build up to 100 billion if that's what you think is coming up for British Columbia in terms of a catastrophic loss. I'm sure after collecting premiums for several decades, you can, create that $100 billion fund easily. Same thing with the insurers in Quebec. Start promoting the to policyholders to purchase that coverage, and start creating that fund to create that stopgap measure against the potential losses, catastrophic losses that an earthquake can present. Like I said, you're collecting the premiums for that coverage, so let's start creating that fund to protect yourself and the policyholders in Canada from that big one that's going to be coming eventually. But let me know what you think of that idea, if I'm totally off my rocker, or if you agree with me. Let's start that conversation. Our last article comes from British Columbia, an interesting situation that I don't know if you could say it's unique to British Columbia or could apply to other provinces as well. Man billed $1,500 for a vehicle he didn't own. Insurer says he still has to pay. Legal loophole means sellers can be held responsible for vehicles after they sold them. While Darren Nash sold his used SUV last spring, he thought the deal was done. After all, the 66-year-old retired truck driver who lives near Langley, BC, is a self-described car guy who says he has plenty of experience buying and selling vehicles. A couple months later, Nash says he was blindsided by a $1,500 towing and storage bill for a vehicle he no longer owned, thanks to what he calls a terrifying loophole in how vehicle transfers are handled. It's a problem, Nash told Go Public, a very strange situation. I didn't know what to do. While Nash was in the hospital recovering from open heart surgery in March, his grandson, with permission, sold the family's 2004 Acura MDX to a stranger. It wasn't worth much. The aging vehicle had more than 300,000 kilometers and mechanical issues, so they sold it for $500 cash. The buyer filled out the proper transfer forms, brought his own plates, and drove away. Two adult people made a deal, shook and signed papers, and transferred money. That should be the end of it, but it doesn't seem to be that way, Nash said. About 3 months later, after the sale, the RCMP called. The vehicle had been found abandoned about 35 kilometers away, uninsured and still registered in Nash's name. I got a call saying that this vehicle was in Surrey on the side of a road with no plates on it, Nash told Go Public. And I said, oh, I sold the car a couple of months ago and I have the paperwork for it. And he goes, oh, then you're fine. A couple of weeks later, after that call from police, Nash opened a letter from a towing company demanding payment because the buyer never registered the vehicle. Legally, it still belonged to Nash. The tow truck company just pretty much said, well, we'll just send it to collections, Nash said, adding, and you'll end up paying it because it'll ruin your credit. Experts say Nash's situation could happen to almost anyone who sells a vehicle in most of Canada. Scott's can't make quite a blanket statement like that, in my opinion, because law's different. Because we're talking about vehicle registration, which is up to the provinces. There's no one law that applies across Canada, so what situation might happen in one province doesn't necessarily mean it's going to happen in another just because of the different laws, but that's just my opinion. Scott Stanley, an automotive insurance lawyer and partner at Murphy Batista LLP in Vancouver, said Nash's case exposes a serious gap in most provincial vehicle laws, one that leaves honest sellers on the hook for someone else's mess. He said the issue is simple. Only buyers are required to transfer the registration at the vehicle registry office. The seller doesn't have to be there. So if a buyer never completes the paperwork, the seller's name stays on the registration, and with it, the responsibility for tickets, towing, insurance, or possibly criminal liability. You're getting criminal liability? Really? That's going to be hard to prove. Criminal intent for somebody who doesn't even own the vehicle. Okay. Nash is not alone. Rob Fournier, an independent vehicle examiner in Langley, BC, says he believes a lot of people skip confirming their buyer completes their registration. How is the buyer going to, or how is the seller able to confirm that the buyer completed the registration? Most people just kind of step over that step, not realizing how crucial it can be. Stanley said the gap puts honest people at risk as they rely on buyers to do the right thing with no system to make sure they do. He said the seller can be left responsible if the vehicle is involved in a crime, accident, or any sort of mischief or harm that can happen when someone has a vehicle. It's different if you buy a car from a dealership. That's true, because that's where you're sure that the vehicle is being transferred. Even with proof of sale, BC's provincial insurance corporation of British Columbia told him he was responsible for the towing and storage charges. He said he hasn't been able to track down the buyer and doesn't blame the tow company or police. He blames the system. They said until it has a stamp, it's not a binding contract. Okay, it seems to have all the elements of a contract. So I'm not sure having a stamp doesn't make the contract invalid. He said even his local insurance agent was shocked. My auto plan dealer was horrified. She told me she's been saying for years that once you have your seller's copy, you're good, but it's not true. Nova Scotia and Newfoundland and Labrador are among the few provinces that have closed the loophole. Those jurisdictions have a built-in safeguard that protects vehicle sellers. System experts say other provinces and territory could easily copy. Why don't they? This seems like a situation that should have been resolved a very long time ago. So, folks out there, you should contact your provincial representative and tell them that this is a situation that could occur in your province, unless you're in Nova Scotia or Newfoundland and Labrador. So, I don't know why they just don't copy what some of the Atlantic provinces have done to try and protect consumers in other provinces as well. In most provinces, the seller fills in a paper or online form to transfer the title and then leaves the rest to the buyer, trusting the new owner will register the vehicle in their name. Many provinces recommend the buyer and seller go together to get the transfer forms officially stamped, but do not require it. But in those places that have fixed the legal loophole, the law adds one crucial step. Sellers must file the notice of sale portion of the certificate of registration and submit it to the registry of motor vehicles listing the buyer's name. That simple step instantly removes the vehicle from the seller's record, shifting responsibility to the new owner. There's no confusion. Fournier says the fix could easily be implemented in other provinces, but there's a lack of motivation to change things. Why? How difficult can that be to put through a bill like that? What opposition party would be against the government from enacting something that's going to protect consumers when they're selling their vehicle? In jurisdictions that have fixed the loophole, the buyer and seller are required to sign a bill or special transfer agreement and submit it to the vehicle registration. Legal experts say it's an easy fix, but the provinces that CBC looked at, including BC, Alberta, Saskatchewan, and Ontario, and more, are making no move to adopt it. That's nothing really else new regarding that article, but definitely a word of warning when it comes to if you're planning to sell your vehicle privately. Don't just assume that the seller or the person who's buying the vehicle is going to go through with the process to actually transfer the vehicle. Whatever steps your province allows for you to try and notify the ministry or whoever's responsible for vehicle registration that you have sold the vehicle. Definitely take advantage of it because you do not want this to happen to you. It's interesting about the liability aspect that the article mentions. Uh, if after selling the vehicle, it'd be interesting to see. I don't recall ever seeing a court case in a jurisdiction that has private insurance, like in Ontario, that sort of court case ever happening, where somebody has purchased a vehicle, taken the vehicle with them, got into an accident, how the seller can still be liable, whether the insurance company would still cover that, because technically they don't own the vehicle. They might own it on paper, but legally they sold the vehicle. So it's just like a situation where somebody steals the vehicle. Uh, the the civil law does not hold the vehicle owner liable, except in very specific circumstances, for damages that occur from somebody who steals your vehicle. I find it odd that civil law would make, in those common law provinces, that uh, makes vehicle owners liable for accidents after they sold the vehicle. It's not like the seller has any ability to transfer the vehicle out of their name, so putting the responsibility on the buyer to do that makes it a bit of a tricky situation for people who are trying to sell vehicles privately. So, word of warning, do everything you can after you've sold the vehicle to try and get that vehicle transferred out of your name, or at least notify the authorities and the organizations responsible that that vehicle no longer belongs to you. And that is it for me for today. I'd like to thank you for joining me. If you like what I do here, please leave a like on the video. Please subscribe for more. Please follow Insurance in Canada on Twitter/X. And until next time, bye-bye.